Hi, I'm Alvin, I'm the CEO of Dr. Wealth, and today I'm going to share with you 10 financial ratios that you can use in your investment. I do know that there are many ratios out there, probably like thousands. I never count it, okay? But I do think that there are so many that a lot of investors find trouble in understanding them and also to know what to use at which point in time. Okay, so I want to share with you how this 10 ratio can help you invest better. All right, so let's go to the very first one, which most people would know about, which is the PE ratio. Okay, the PE ratio is a very simple ratio. It's essentially just a price divided by earnings per share. Okay, so what it tries to say, right, is that price is the amount that you pay for the stock performance, which essentially is the earnings. Of course, you want to pay a lower price for the earnings that you're going to get, which means that you want this ratio to be as low as possible, right? Then you get a good deal out of investing in this company. And something to note about this is that you can only use this for companies that are already making a profit. So if a company is not making a profit, this PE ratio doesn't work, right? There is no such thing as a negative PE ratio. The most you want it to be is that it gets close to zero as much as possible. And with that, it's also not consistent across the industry. That means some industry will trade naturally at a much higher PE ratio compared to other industry. So there is a typical standard, but as a rule of thumb, if you see a PE ratio that is in a single digit, usually it is considered a value stock, right? It's considered a cheap stock to buy. So this is a very simple ratio, and some people may even talk about, what does it mean when the PE ratio is 10, for example, right? So you can also say it in a way that it takes 10 years for the company to make enough earnings to be equivalent to the price you pay for the stock, right? So you can also see in a way that this is the P ratio number is actually the number of years it takes for the company to catch up with the stock price that you have paid with its earnings. All right, so I hope that explanation gives you a good idea what this P ratio can be used. So you want it to be low in order for you to buy a stock at a cheap price. Okay, so now we will talk about the second financial ratio, which is the PS ratio, or price to sales. Okay, sales is equivalent to revenue. It's a top line item of financial statements. All right. Just now I mentioned that PE ratio cannot be used if a company is not making any earnings, if it's making losses. This is particularly true for companies that are young. If you see a lot of those young tech stocks, they are usually making a loss, and most of the time the most crucial number is their sales, right? Because they are trying to grow as fast as they can and to capture market share as fast as they could. And with that, sales become a very important number. Sales growth becomes a very important number, and you can use price to sales instead of price to earnings for this kind of stocks which they are making losses, right? So again, same thing. This price to sales ratio is about comparing the price that you're paying for the stock versus the revenue that the company is generating. Likewise, with PE ratio, you want this ratio to be as low as possible so that you're getting a good deal out of it. Okay, so now let's go to the third ratio, which is the PEG. Okay, it stands for price earnings ratio divided by its growth rate, right? So the formula looks something like this. We already covered the PE ratio as the first ratio. You just take the PE ratio, divide by the earnings growth rate. Okay, earnings growth rate, right? So I give you an example. If let's say the PE ratio is 10, okay, and then it is growing at say 20%, right, in terms of its earnings growth, so the PEG ratio will be 0.5. All right, and any number that is less than 1 is considered a cheap point to buy, right? So if the PEG is below 1, it's good. If it's above 1, it tends to be overvalued in terms of the growth that it's delivering. So how this ratio works is that you don't just purely look at PE, because there are some stocks that are growing, and as a stock that's growing, it commands a higher premium for its stock price, right? So what you can do is that you take the PE divided by the earnings growth rate. That will help you normalize the premium that you pay for the PE ratio. So in other words, the higher the earnings growth, the higher the PE ratio you can pay for the stock. Okay, so in general, just remember if the PG ratio is less than 1, then it's considered undervalued and it's a good time to buy. If it's above 1, it usually means that it's overvalued. And this can only be used on companies that have positive earnings as well as their earnings are growing. All right, if its earnings are not growing, this PEG ratio is irrelevant, and just using a PE ratio will be good enough. Okay, so we have covered 3 financial ratio. We are going to the 4th one, and we are going to talk about this price over free cash flow, or FCF in short. Okay, so just want to write it out. So price is price, and then the denominator is free cash flow. Okay, this is a very popular metric amongst investor, the more sophisticated one, right? Because they don't just want to look at PE ratio. The reason is because of accrual accounting principles. We have an income statement, we have a cash flow statement, and they don't usually talk about the same thing, right? Because for example, a company may have already delivered a service, but the company may not have collected the cash, right? So it will have recorded an earnings in the income statement, but operating cash flow may not register a cash inflow. All right, and there can be another situation where they have collected the cash but they have not delivered the service, which means in the income statement the revenue is not recorded, but in the cash flow statement the cash has already been in the company, right? So because of this kind of accrual accounting principle, it is important to look at the cash flow, because at the end of the day the business survive on cash flow. You need to pay your suppliers, you need to pay your landlord, you need to pay your staff, you need to pay a lot of people, right? You have to use cash to pay. So if a company doesn't have cash flow, it only have earnings but have not collected money from their clients, it can become a cash flow issue. You can pay a lot of people and the company may be in trouble, right? So this become an important metric. And likewise, as a PE ratio, you want this ratio to be as low as possible. And if you invert this, and this is what some of the investor will use, it's called the FCFU, or the free cash flow yield. So the inverse of the price to free cash flow ratio will be the FCFU, and likewise is the opposite, right? So you want this ratio to be high as possible to be considered a value buy. We have come to the 5th financial ratio, and it is a favorite among dividend investor because we're going to talk about dividend yield. Okay, dividend yield is one of the 2 returns that a stock market can reward a shareholder. There are only 2 ways. Okay, one is dividend yield, one is capital gain. And there are investors who deliberately just buy dividend stocks because they want the dividend, the cash flow that goes into their bank account. They may want to use it for some of their expenses or even for retirement. All right. So this dividend yield is a very simple ratio. It's just taking the dividend per share divided by the share price. All right, so that means based on the price that you buy, you pay for the stock, how much dividend are you going to get from it? Okay, and of course you want this ratio to be as high as possible, then you get a good deal out of it, right? So some people talk about, oh, this is a 5% dividend yield. That means that for every $100 you invest in the stock, you get $5 back. All right, so that is how a dividend yield works. And as I said, this is only more for dividend investors, because not all stocks give dividends, right? There are stocks that are, especially the growth stocks, they don't give dividends at all. The management would rather keep the earnings and to grow the company further, right? So for dividend stocks, they are usually not growth stocks. They are usually stable stocks in a matured stage, and they can be well-known big caps, blue chips company. And some investors just prefer to invest in this kind of stocks, and dividend yield becomes a very important ratio for them. We have come to the number 6 ratio, which is the payout ratio, related to the 5th ratio, which is dividend yield, right? Because it's not just good to look at dividend yield alone, you also want to look at the payout ratio. So what is this payout ratio? This payout ratio is dividend per share divided by earnings per share. Okay, it just means that for every dollar of earnings that is earned by the company, how much of this dollar is given out as dividends, right? And for example, if the company makes a dollar, right, per share, and it decided to give out 50 cents dividends per share, that means that the payout ratio, right, I'll just write in short in PO, will be equal to 0.5, right? And in this case, you know that this is sustainable, right, because they didn't give out more than what the company earns. So a sustainable payout ratio is usually less than 1. Okay, so but there are cases where a company can give out a payout ratio of more than 1, right? You might be wondering, how can the company give out more than it earns? Because the company may have retained earnings in the previous year, and they are just using what they didn't give out in the previous year and give more this year. Maybe it is an exceptional year and they decided to just reward the shareholders with more dividends. So payout ratio can be more than one, but usually it's not sustainable. You don't expect the same amount of dividends the next year, especially when the management announce that it is a special dividend, right, which is not ordinary. Okay, there's two kinds of dividend. One is ordinary, one is special, right? So it's special means that it is unlikely to repeat. So if you see a payout ratio that's more than one and there's a special dividend announced by the management, likely next year the dividends will fall again. Right, so it is important to look at the dividend yield in conjunction with the payout ratio, and you will know whether this dividend yield is sustainable or not. Okay, we are now at number 7. We are going to talk about price to book ratio, or PB ratio in short. Okay, this is a very classic metric for value investor. Okay, it's called price to book value. Right, as with a lot of price multiple ratio, you want this to be low. All right. And let's explain this book value. This book value is actually what you call net worth of a company. You're just taking assets minus liability. Right? So essentially, this ratio is about buying the underlying assets of a company, and which means that the assets has to be valuable. If the assets are not valuable, then this ratio doesn't make sense, right? And we talk about nowadays there are asset-light tech companies, and they don't have a lot of all these assets, and that means that your PB ratio cannot work for these companies. So PB ratios are better for companies such as the property companies, right, with a lot of valuable real estate, or it can be banks or insurance with a lot of investment products or cash in their balance sheet, right? In those cases where the assets are valuable, then this PB ratio can be a very useful metric to use. Number 8 ratio, we will talk about ROE. Right, return on equity. Okay, so the previous ratio that I've shared are all price multiples. That means you compare to the share price, but this is nothing to do with the share price. This is just the fundamentals of a company. Right, you have probably heard of this ROE quite frequently as an investor. All right, what it means is that you are taking the earnings, okay, and divide by the equity. Right, sounds like very, very difficult to understand. Okay, so I'll break it down further for you. Right, you heard about the book price to book value previously, right? So book value is the same as equity. Okay, it's also equivalent to the net worth of the company, right? Which is essentially assets minus liability. Right, as a shareholder, you own the equity part. Okay, you're an equity holder. Right, so what this try to measure is that as an equity holder, what is the kind of returns you are getting, right? So definitely you want this ratio to be as high as possible. That means this business is giving you a good return for the shareholders. All right, so that is what ROE is all about. Okay, it's just earnings, right? How much earnings is generated for the shareholders. So that's how you can look at this ratio. Right, but you have to be careful about this ratio is that if the liabilities goes up, right, you can see if the liability go up, the equity actually goes down, and if this equity goes down, this ROE actually goes up. So ROE has a leverage factor, right? So sometimes a company can appear to have very high ROE, but it could be because it was amplified by debt. Okay, as the ratio as the workings have shown you, right, increasing the liability will reduce the equity itself, and that increases the entire ROE. So you have to look at it by using another ratio, which I'll talk about in ratio number 9, which is return of assets. So let's move on to returns on asset, ROA, ratio number 9. Right, as I share with you, ROE should not be look at it by itself. Right, you have to take care of the debt level, and ROA would probably review it. All right, so ROA is the earnings of a company divide by its assets, total assets. Okay, so assets would have included both the equity plus the liability. Okay, so shareholders, you're on this side, right, which is the equity side, which we talk about in ROE. And then this liability is your bondholders, your creditors, which are on the other side, right? So these two group of people actually help to fund the assets in the company. All right, and because just now I told you if you only take ROE, if the liabilities go up, you actually have a very high ROE, which is undesirable. So when you check it, double check with our ROA, it will give you whether the company is leveraged or not. If your ROE is very close to your ROA, usually what it tells you is that the leverage is minimal, right? If you have a very high ROE but a very low ROA, that means the company is leveraged by pretty much a fair bit. All right, so that is how you can do a check. Okay, so you want the ROE and ROA to be both high, right? Not one higher, much higher than the other one. And in that case, then the leverage factor is inbuilt into the formula itself. So we finally come to the last financial ratio, and it is nothing to do with price again. It's nothing to do with returns. It's more on the debt level, right? So I'd like to introduce you to the debt to asset, okay, right, ratio. Some people can use debt to equity, but you can use debt to asset, whichever you prefer, right? Just make sure that you're very consistent in your comparison. You don't take debt to asset from one company to compare with debt to equity from another company, right? We're talking about two different ratios. So just make sure that the ratios are similar when you do a comparison, then you should be fine, all right? And this is also known as the gearing ratio. So when someone say that, the gearing ratio is high, right? Essentially what it means is this debt to asset. Okay, so you want this ratio to be low, okay, because you don't want a company to be very indebted. When it's very indebted, a lot of problems can happen, right? If when a company can't pay its services loan, then some collaterals will be taken away, right? And the company will be ending up in a spiral. They will lose even more assets along the way, and the share price will usually plummet. So just be careful. You don't want a high debt to asset ratio. You want a low debt to asset ratio. And especially in REITs, right, real estate investment trusts, this is a watch area, right? In Singapore, they are not allowed to have more than 45% debt to asset ratio, so they must keep within this ratio. It was only during COVID that they raised it to about 50%, right? But for normal period, it's about 45% and below, all right? So this is if a REIT that is very close to this debt to asset mark, and raising more money via the debt route will be difficult, and likely a rights issue, right, to create new units and sell it to existing unit holders, that chances of this happening will be higher. So we have come to the end. I've showed you 10 financial ratios. I hope the explanation has been clear, and hopefully you can use some of this and make your investment a lot better in the future, right? Thank you very much for watching. Remember to like the video and subscribe to our channel, and I'll see you in the next video. Goodbye.